Everything now boils down to this golden thing about investment banking. What is investment banking? What are the different types of profiles available in investment banking? I'm going to discuss all the nitty gritties about the various types of profiles, what kind of work they do, what kind of skill sets you need to do this. Enjoy this detailed video.
How is this linked to investment banking? We've just touched base upon the organic growth part and the capital sources. Like equivalently, I will touch base on the inorganic part as well. Okay. Now, these verticals that you see, the areas from which you can raise funds through. Okay, I'll just rewrite that again so that it is clearly seen by everyone. Sources of capital. Okay, so which were the sources? Somebody please repeat.
Debt, equity, grant,
Debt, equity, government grants,
internal accruals.
internal accruals. Okay, these were the sources that we identified as the sources. Okay. The next few minutes are going to give you a clarity on what is investment banking via the on the ground reality. Okay, so let's see one by one. So, who are investment bankers? These guys are the intermediaries. They are the ones who help the CEOs of companies who are seeking to grow either via the organic route or the inorganic route. Okay, imagine yourself to be a CEO of a company, that shirt or the apparel player. You are doing great in your business, your products are great, they are stellar, people love it, and you want to grow. Now, chances are very strong that you are, expert in your domain, but you may not be able to answer the question as to which are the best sources for you to arrange the funds for your growth story. Whether you should go for a debt route or equity or government grant, or you should use your internal accruals if you are pursuing the organic growth route. If you are pursuing the inorganic growth route, which is the company that you should acquire for? How will it fit you? I will go into the details in a few minutes. Okay. To answer those questions, you need some intermediaries who will help you answer these questions which address this gap. And investment bankers are those intermediaries who help you do this. To be precise, if I'm looking at the debt mode of financing or debt vertical of financing in an investment bank, you have a group which is known as debt syndication group. You have a group which is also known as debt capital markets, DCM. The prime responsibility of the bankers which are sitting in this group, if you're an analyst sitting in the debt syndication or the DCM group, you will primarily be involved in networking with banks, because primary source of capital, at least in the Indian markets, are banks. You will help your client to raise loans either for the long term or short term from the banks. You will have a very strong working relationship. You will know the managers, general managers of some top PSUs, some top private banks for a particular location. You will be a representative. You will be your client's representative in front of the banks. Yeah. So, a client, like let's say you want to expand, you're a consumer company CEO, you will reach out to an investment banker. I will prepare all the documents, all the analysis, and I will represent you in front of the bank. Everyone with me so far? Any questions, people? Yes, no, maybe. Are you guys with me? Have we understand?
So, am I audible?
Yeah.
So, sir, someone who is working in the ratings, like the similar kind of work, like getting all the information, starting from their business, and then preparing the information and everything, and presenting it in front of the committee. So, those aspects also will be considered under this, or it's a bit different because there also we connect with the banks and like we work basically on behalf of the client.
You're talking about the ratings part?
Yes, yes, sir.
Yeah, I'll
They're
come to
like
that.
receive.
I'll come to that. Just give me 2 minutes. I'll come to that. Yeah. You represent the client in front of the banks. Yeah. And in order to represent them, the banks, they will not easily give you the loans. They will ask, what is the feasibility? They will ask for something called as the feasibility reports. What is a feasibility report? Feasibility report, in other words, they are also known as information memorandums. और pitch books नहीं बोलेंगे, information memorandums ही बोलते हैं most of the times, or alternatively feasibility report. It gives the details of the business of your company, of your client's company. It talks about what the business is, what kind of products, services does it offer, what is the manufacturing capacities, what is its asset base, who are its key clients, where does it operate, the geographies of its revenue, the financials, everything gets covered under this key things so that the banks understand the business of your client's company. That's the first step. So you as an analyst sitting in this group will be required to build this type of IMs feasibility reports by going, visiting your client's company's site, taking documents from them, or maybe take information from the public domain and build this comprehensive report. Additionally, banks will also make you prepare models which are known as CMA statements. Now, banks say that okay, we want to know the financial model of the company, but we would want it in the template that we understand. So every bank will have their own respective CMA format or CMA statement, which is nothing but a template of the financial model which the banks advise you to fill up. So you as the investment banker, you have to fill up the financial this CMA statement, which is nothing but a model, submit it to the bank, and they themselves, these models, these CMA statements will calculate all the interesting aspects like credit ratios, uh, the cash flows and everything. The model will calculate, which will eventually help the bank decide whether to go ahead and extend the loan to your client or not. Because you have been networking with the banks, because you regularly give business to the banks, you are expected to get better covenants for your clients. Have you heard this word covenants? Do we understand what does this word covenants mean? What is a covenant? People, have you heard this term? Covenant.
Terms and conditions.
Terms and conditions. What are these terms and conditions? It could be positive covenant, negative covenant. Probably, one of the terms and conditions could be that you have to, let's say, the client company, the banks impose these conditions on the borrower. They may say that, okay, you always need to maintain a debt to equity ratio in a certain way. Or if you're planning to raise additional debt, you have to take an approval from our side. Or, uh, you know, we should be the ones who should be prioritized when it comes to repayment. Or these are the mandatory repayments that you have to make as on a particular given date. They will give you the repayment schedule. Yeah. Such covenants might be a bit of strict rules that the banks may impose on your clients, but because you're working with the investment banker on a regular basis, the bankers may try to give some relief, some better terms and conditions for their clients, and such that it doesn't impact their businesses negatively. Yeah, it's the job of the banker to get better terms and conditions from the bank for your client. So that's what the group which sits in this debt syndication team does that, or a DCM. DCM is more or less related to the public markets, which is the bond markets. In India, we don't have that much detailed or deep bond markets, but yeah, it is there. But you will see this happening in the Western markets. Now, when it comes to debt syndication, there are peripheral profiles as well. There are groups which help the companies uh, get ratings from agencies like CRISIL, ICRA, and other things. So what happens is, who are these rating agencies? They are the ones who give the companies credit ratings. You must have heard these terms like the double A or companies given a triple A rating or a double B rating or B plus or B minus rating. So depending on the level of debt which they have taken on their books, depending on the cash flows that they are generating, and how strong are these cash flows against the repayments that they have to make to these banks. Yeah. If they have a stable cash flow, if they have a strong cash flow and they can easily repay the loan and they have been doing it regularly in the past, then they are AAA rated companies. So there are processes to do that. So these kind of profiles, they are also have some peripheral openings which include profiles of ratings where you have to liaise with your company, get the details of the leverage levels, sanction letters, connect with the banks, verify whether the details that the company has suggested or given them is accurate or not, prepare a feasibility report and submit it to these rating agencies so that these rating agencies give a suitable or probably a favorable rating or as is rating to your company. Yeah. So it is not a core IB role, but it is a peripheral role which probably is not directly helping a client in raise a loan from the bank, but helps in building one of the important parameter which the banks will definitely look at before extending any kind of loan to a client. Are you with me, Archana? Did you understand the logic here? Yes, no, maybe. Others, are we good?
Yes, understood.
Everyone with me so far? Yes, no, maybe. Are we understanding this?
Yes, sir.
Yeah, Riddhima, are you with me? We
Yes,
just
sir.
Yes, yes.
yeah.
Yes, sir.
Sir, can you please talk more about the CMA part? I didn't get it completely.
So CMA is basically, in order to paint the financial position of a company. Okay, the banks will look into the financials of the borrower. Okay, financials as in there will be. This is nothing but an actual financial model. The financial model will have your P&L, will have your balance sheet, will have your cash flow statement, and all of these will have the projections, forecasts. Now, banks would like to see that if they infuse or if they are ready to give them a 10 crore ka loan. Okay, let's say the bank agrees that okay, we are okay, we like the feasibility report that you've done, we believe your business is growing, and we can give you this loan. So banks would like to take a look at the projections. How are your EBITDA levels would be in the future, along with your cash flows from operations, cash flow from financings, and cash flow from investments, such that would you be strong enough to repay the principal as well as the interest component on a timely basis. Okay, These projections help the banks decide this, whether the 10 crore that has been given out, whether the company can repay this on a timely basis based on the repayment schedule that the banks need. Banks at time also will set apart, okay, by first year I want 5% of the loan to be repaid, by next year I want 10% of the loan, by next year I want 15%, and then so on and so forth. They will give you a yearly schedule. The projections are done in such a way, or looked at in such a way, whether the company would be able to meet these repayment schedules or not. Are you understanding this? Are you with me, Kashyap?
Yes.
So your model, your job as an analyst is to create these models, these forecasts, and tell the bank that look, we are showing you a situation where 10 crores have been taken from you, and look at the position of the company. They are going to use this 10 crores to buy plants, machines, and and because of this plants machines, they are now able to produce 1 lakh unit per month. They already have a positive demand, and factoring that demand into revenue and eventually into EBIT or EBITDA, the cash flows also look strong. And from that current cash flows or those values of cash flows, they are comfortable enough to repay your principal and debt on a timely basis as per the schedule that you have asked them to. Are you with me? Are we understand this? Yes or no?
Yes, yes, sir, understood.
Yeah. So this is what you do. That's your debt part of things. Yeah. Everyone with me? Did we understand so far what the debt part is? Yes, no, maybe.
Yes, sir.
Yeah. Now let's come to the equity part. Okay. Now what are the different sources of equity funding? You've seen this. You can get the money from VCs, PEs, or from the capital markets in the form of IPOs, FPOs, rights, or private. There are other instruments as well. But what I have done is, if you observe the way I have written these, they mimic the life cycle of the company. These are the investors, equity investors. If I put the life of the company, this is a stage where you are a startup, and this is a stage where you are fairly mature. When you are a startup, the kind of investors who would be keen or who would be willing to put money or give you money, they are your venture capitalists or angel investors. And then as you grow, as you reach the growth stage or as you reach the maturity stage, you get investments from private equities or late stage VCs. And then as you grow further, as you mature, it depends upon your willingness as well. But you can definitely go for an IPO where you get money from the public markets. You ask the retail investors, institutional investors to invest their money into your business. And then if you still need capital in future for some of the big projects, you can again go for further dilution in the form of follow-on public offers or rights issues or private placement. The things are going on. But everything falls under the equity mode of financing. Yeah. If you are sitting in this category, if you're sitting in this vertical, okay, these are verticals in which probably which the investment banker teams are distributed. If you sit in this team, you can be called as equity capital markets group, which is the ECM. If you're focusing specifically on the private equity part, you're called as a private equity group. Yeah. ECM typically would look into all these public related instruments like an IPO, FPO, rights, private placements. Anything and everything that is concerned with a company going in the public domain falls under the ECM category. Anything that falls under the category of raising funds through private equities, you have a dedicated group for that. You call them PE group or the origination group. And when it comes to the early stage, you have groups where you connect the venture capital investors or angel investors to startups. This is where the profiles of venture capital analysts come into action. Yeah. The process more or less remains the same, but the target investors are on the other side. They have more skin in the game. In this previous situation, in the case of debt mode of fundraising, the returns that the debt investor is interested in is the interest component. Interest is the return that they will generate. But in case of equity, they give you the capital and they take part in the ownership of your company. So they are subject to any upside as well as the downside risk. Yeah. In order to reach out to these investors, you have to, let's say if you are sitting as an analyst sitting in the private equity group, you have to be, following the same process as here as well. What do you do? Let's say you will be networking with private equities. Private equities are nothing but these are the financial investors. They have investment criteria. Private equity, they have the investment criteria. They will say that, I'm just giving you one example here. They will say a private equity typically says that, or let me write it in this space here. Private equity investment criteria. A private equity typically says that, okay, I am going to invest, let's say, only in the healthcare sector. What is a private equity, by the way, before I go into the criteria? Can anybody tell me what is a private equity? What do we understand by the word private equity? What do these firms do? Any idea? People.
Where you don't sell your equity shares to public at large, that is by IPO, but you sell your equity shares to a private individual or a fund.
Mhm. Mhm. What else? What else? What else? People. Any idea?
So private equity investments are generally done when the company is in the growing stage. I mean, of course, up to the angel stage, when the company has started making some revenues, and at the time when you raise the money from HNIs or any private companies or investors, then they invest for the partnership in the company, and they help you grow with their expertise and networking as well.
Mm-hmm.
So they will be in the business for a shorter period of time, as you mentioned with the other financial investors. So when they will get the return, they will like exit from the business. It can be through IPO or similar. Also, I'm confused, but basically they are into the buy side of the business.
Mm-hmm. Yeah. So what are PEs basically? Thanks for your answers. These are really encouraging. Uh, PEs are financial buyers. There are two types of buyers: financial buyers as well as strategic buyers. Financial buyer is the one who would invest. Folks, one of your just mute yourself in case you don't have any questions. Yeah, thank you. Yeah. Financial buyers, they put their money into your business with an intention of purely generating some returns out of it. Okay, that's your financial buyer. Purely you just want to, make some IRR or returns out of your investments. You don't wish to stay ahead for the complete life cycle of the company. You just there for few years. You put 10 crores. After 5 years, you convert that 10 crores into 15 crores. 5 crores is your return. You sell off your stake. Okay, PEs are your financial buyers. Then you have strategic buyers. Strategic buyers are more interested in the synergies. Synergies is nothing but the long-term growth potential of the combined entity. Okay, these are your large potentials, your corporates, large companies, corporates like L&Ts or Reliances or actual company, which will acquire another company, and they won't stay invested for a few years. They will amalgamate, they will consolidate the operations, and exist as a combined entity forever. That is what the intention is. Now, private equity as a institution or as a group, they are made up of individuals who have previously been CEOs of some companies. Yeah. For example, if a private equity says that we focus purely on the healthcare space, chances are very strong that they have some ex pharma CEOs sitting on their boards who evaluate the companies, specifically the pharma companies, and they decide whether that opportunity is worth investing or not. Yeah, these are some of the very smart people who are there in the business, and because they have the experience of running the business, they are in much better position in understanding whether the opportunity is worth investing or not. Okay, so they will say that we will invest only in the healthcare space. They typically invest in the growth stage company. So when you're like not at the mature phase, you're still growing, you're still have a potential to tap in more clients, you are in that stage. They will say that they invest in ticket sizes. Let's say that they will make an investment of typically, let's say US dollar of 50 million to US dollar 70. I'm just giving you a hypothetical example. So they will say that we will put only an amount which is in the range of 50 million to 70 million. We will not do anything less. We will not do anything more. Okay. So if you are an analyst who has been approached, or your company has a client which is into the healthcare space, which is in the growth phase, which requires, let's say, $60 million of funding, and that company is open to divesting of certain stake in the business. So you will create a list of all the private equities which have interest specifically in the healthcare space, who are interested in the growth stage, whose ticket size falls under your favorable criteria. And to those private equities, you will get a list of private equities, and to those private equities that you have screened out, you will start making pitches. You will pitch to these private equities. And how do you pitch them? You will create collaterals. You will start by preparing something called as teasers. You prepare something in details called as information memorandums. You prepare something called as financial models. Okay. You will start preparing the teaser of your client company. Teaser is a no-name document, as the name suggests. It doesn't give out too much of details. It should be 1 or 2 pages long, which highlights the main details or USPs of the company, and you will share it to those 20-30 PEs that you have screened out, which follow this criteria. Once you send out these teasers, probably out of 20-30, maybe 8 to 10 PEs will come back and say that, okay, we are interested in the opportunity that you shared us. We want more information. Now, if they say that they want more information, then you prepare these detailed documents called as information memorandums and pitch books. You call them as alternatively, use these terms, along with the financial models. They cover detailed information about the company. You have all the details given out here about the business, about the growth, the management, the things. Everything in details is given in your information memorandum, and the financial model covers the detailed forecast and the nuances of the financial part of the business. Now, because these detailed documents, everyone with me so far? People, yes, no, maybe I've been on a monologue
Yes, sir.
for a while.
Yes,
But
sir.
is everyone
Yes,
with me?
sir.
Have you understand?
Yes.
Yeah. Okay. Any case, if you don't understand, you know what to do. Yeah. And whatever I'm discussing, we are going to see each and every collateral, all the things in detail. I'm just giving you a macro picture of what this course, what IB is all about. Okay. So we will go into the details of what a teaser looks like, how to build that. We will go into the details of what IMs and pitch books are, how to build them. We will go into the details of different types of models applicable in the debt side, in the equity side, in the merger side, LBO side. So we have all those things planned up for your sessions in the future. So it is just a macro view. Yeah. As I was saying, because this has all the details sitting in it, which may be a bit of strategic in nature, which may be confidential in nature. So before giving out these details to these PEs 8 to 10 who are yet to invest in this, they have just cited an expression that okay, they are interested. But they haven't given out okay, we will invest. So your confidential information cannot be directly submitted to these PEs. You will make them sign something called as non-disclosure agreement, NDA. These are legal documents which prevent these 8 to 10 PEs, because you will be sending this information and you will make them, before sending them you will make them sign this NDA. This agreement makes these investors prevent from using the confidential information or sharing this information for a period of, let's say, 6 months to 1 year, if they decide not to invest in this company. Yeah, this confidential information cannot be used by these guys or shared with someone else for their own benefit. Once they sign the NDAs, then you go ahead, you share these two documents with them. Okay. Once they receive these documents, the list might boil down to probably 4 to 5 P. Some will back out after receiving these details. And out of these 4 to 5 PEs, some will be further interested and they will have their questions about the stuff that you have given. Your job as an investment banking analyst is to get these questions answered either directly by yourself if you can, or get the management answer these questions and you return these questions to these 4-5 PEs. And if these, out of these 4-5 PEs, if you are left with, after this stage, you will be left with like, few more may back out. I'm just giving you a hypothetical situation, but this happens in reality. Yeah. So, out of this, probably 2 or 3 are now left with you. They will say, okay, we're satisfied with the answers, we need further details. So we want to verify the things that you have shown in the model, and that phase, the model, like or the pitch books, everything that you show in your IM and pitch book, everything that you mention as facts or figures, claims, they are verified in these rounds which are known as due diligence rounds. Okay, where the financial sponsors may ask for asset titles. If you say that this is asset belongs to you, they will say, come on, show us your asset title document. If you say that only this much amount of loan is left, then they will say, come on, show us the sanction letters which the banks have given you on this loan. Sanction letters are nothing but the legal agreements which the banks give to the borrowers, stating that these are the terms, conditions, amounts, interest rates, every detail about that loan is captured in that document. Yeah. So like this, all these things are getting verified, and you as an investment banking analyst will support in this due diligence process, the verification. Yeah. And out of this, at the end stage, probably there may be just one odd buyer who might reach to the next last round, one private equity buyer with whom you will start conducting management meetings. You will make them, management can be introduced to them at an earlier stage also, but you can conduct management meetings. You will conduct valuation discussions, and if agreed, the PE will eventually say that yes, we are happy with the valuations, we are happy with the management, and we want to invest the money in the business. And when that happens, you sign something called as the term sheet. Term sheet means that yes, the financial sponsor has agreed to give you the money. They are willing to infuse the funds into your business, and this is the legal document which captures all the details, okay, about the terms and conditions that the PE would put on the borrower, on that company, about the repayment structure. Yeah. Then there is something called as milestone based funding. So if they say that we are willing to invest $10 million, it doesn't mean that they will infuse the entire 10 million upfront or at one shot. There is milestone based funding. They will set up milestones that okay, the first tranche would be of $2 million. You will receive that at the time of the signing of the term sheet. You will be eligible for the second tranche of $2 million funding if there is an improvement in your EBITDA margin of, let's say, 3%. I'm just giving you some numbers here. If you show that, then you unlock the next $2 million. The third tranche of funding would be, let's say, of $5 million if you show us a revenue growth of 10%. So like this, different tranches of funding will be opening up, and the target company will receive the funding. And the PE can put their own people on the boards of the target company who will govern the operations on a regular basis, give them feedback so that the targets are not matched. And once, you know, the PEs are close to the end of their investment horizon dates. What are investment horizons? The time period in which they typically stay invested, let's say 5 years. They will take a look whether they have achieved those target IRRs. The rate of returns could be 20, 25 plus percentage. If they've reached that stage, they will make an exit from the business. They will sell off their stake to someone else. They will make an exit from the business. Everyone with me? Are we understanding this? Yes or no? Did we understand what the role of you as an investment banking analyst sitting in the private equity group could look like? Any questions so far? Are we good? Yes, no, maybe. समझ में आया सबको?
Yes.
Yes, sir.
Then
So, sir, I have one doubt. If, as you told, if someone is working with as a private equity analyst, so if he or she is working on a particular deal, so his role generally starts from the beginning till the due diligence
yeah,
work, or I mean, it again differs. I mean, it is based on the departments and teams.
yeah, yeah. No, this brings me to this important structure that investment banks are clubbed in, because I'll tell you. Let me write that section as well. There are different types of investment banks. Okay, we have the first category, which we call them as the bulge brackets. We then have some things called as mid markets, and then we have the smallest category, which is called as the boutiques. Okay, now bulge brackets, the names as I told you, and I'm answering this question of yours. Okay, just give me a minute. You have names like Citi, Goldman Sachs, JPMCs, and the other big names. Mid markets probably are Aventus, Everstone, Evercore, I guess that's the name, and some other ones. Boutiques are small-sized banks. Now, peculiarity is the deal sizes. The bigger banks, they will undertake deals which are probably USD 5 million plus in size. The smaller ones, probably it could be in the range of USD 100 mils, somewhere around this range. And they take up, these guys, the boutiques, when they take up smaller deals, the size is not a criteria here. They typically end up with smaller deal sizes. Now, if you happen to be an analyst sitting in this group, the bulge bracket, here you will have departments, okay, where you will have departments like CFA, the advisory, you have departments like valuation, you have departments like transaction service advisories, uh, you have departments like due diligence specific kind of things, where the different deal structures or deal stages are divided between these different teams. If you are a part of smaller firms, specifically the boutiques, where every analyst will have at least 2 to 3 mandates completely on their heads. So this analyst in a boutique IB will be working on a 2 or 3 mandates across the entire deal life cycle. Because these are smaller firms, they don't have bigger teams. The analyst will be a part of all the cycles, all the stages of the deals, and probably they will be working simultaneously on multiple deals. This is what the situation is. Am I making sense? Yeah. Did you?
Yes.
Yeah. So yeah, this is what happens.